Welcome to The Network Effect, hosted by AccessFintech. This podcast series is a discussion across markets, tapping into important topics across trading technology. Each episode will host different guests and different topics, but first off we have our very own voice, Saadon. He is a co-founder here at AccessFintech, and we discussed an important announcement for him and the company.
Yeah, so very exciting time for us right now. We just closed our Series C. We're closing it in a turbulent market, so definitely not the standard experience. Even though I would say for AccessFintech, it's a standard experience because every round somehow always correlates with a turbulent market, but I'm sure we'll dive into that. Yeah, so we're closing Series C. We've raised $60 million from a combination of VCs and strategic investors, with follow-on participation from our original strategic investors. So super exciting time for us. It came on the back of our previous round. So we did a Series B back in 2020, end of 2020, which was the first time we introduced a VC to the cap table. So Dawn Capital came in and joined us together with Deutsche Bank. And that followed on the back of our Series A, which was the first time we raised institutional money. And that was pretty much strategic investors. So we had JP, Goldman, Citi, and Credit Suisse invest in the company. When we started the company, it was actually angel funded. So we used the tax incentives that local governments offer. We did that out of Israel actually. So we had the local tax incentive that attracts private money with someone who's from the industry, but it was a personal investment. And we used that to kick off the company. And from then we did the ABC with just the growing impact and the footprint of the investors. Yeah, so fun times. And all you said was, how are you, right? Yeah, that was a long answer.
Yeah, that's the longest how are you I've ever gotten, I think. So has Series C been the most difficult to secure with the current state of the market?
I'm going to take this as a less formal medium, and I'm going to give more, the less formal answers.
Yeah.
We joke and say that when AccessFintech goes out to raise funding, then people should short the market because the correlation between market turbulence and our funding is quite incredible. When I think back at it, I was one of the founders of a company called Triana, and we started Triana right when the dot-com bubble was imploding. We sold the company right about when Lehman was happening. Now we started the company and we got into our Series B in the height of Corona. Now, Corona was interesting. When you look at the market went on a phenomenal run for a long time. But when it started, it was a 3-week period where the market was tanking and no one knew where it would end. And the natural reaction is global pandemic. We're going into a really long period in red. And we were meant to close the round in the middle of those 3 weeks. And clearly that round fizzled out because no one was ready to even be able to factor risk into the equation and how does pricing change. And now we were doing the round on the back of massively inflated valuations, and the market got into a correction just as we're doing our round. But we had really phenomenal existing investors in both the banks and Dawn Capital. We had a very committed new investor leading the round in WestCap, and we just said, okay, we believe and understand the business model. We believe in what we're doing. It's a real business. Actually, this current situation is an accelerant for us. So people were focused on the business value and addressed it. But yeah, it made the round longer and more complicated because it changed the way the people were negotiating and the firms were, and the way that things were being valued, and the way people were packaging risk into the investment. So yeah, it was quite arduous.
So why are the investment participants so important to growing AccessFintech?
The investors, how do you find? I think it's more a question of fit than value. The most immediate value is obviously cash in the door, and we were finishing a run of 1 year where cash was everywhere and valuations were crazy and cash was cheap. And we were entering into a different phase, and I think at that point in time cash is still your number one incentive, but the question of fit becomes really important. What we like about what we have done is we have a very strong and healthy combination of venture capital and strategic investors. The value in strategic investment is a commitment to a transformation of an industry, not just as the investors, but also they see the value for their firm, which makes them a strategic investor rather than a pure investor. And our investors have a very strong footprint, understanding, and also a history of operators in capital markets, which is, again, very important. The way the capital market behaves, the rate at which it changes, how it manifests, who the buyers are. This is a whole ecosystem. Now, our aspirations go well beyond capital markets, but the immediate growth we have right now is in this sector. So having investors who have operator experience in this space and strategic investors is a massive catapult for us to jump ahead.
How are you going to use the money that's raised? Where's the areas of growth and the expansion to the markets?
You can't. So here's the story. Why do you even go and raise money from VCs? The objective between raising money externally is you're replacing your revenue, which would slow things down if you had to build, with investors who are replacing the immediate revenue in replace for the growth in revenue later on. So the whole idea right now is how do we use this accelerated revenue in a way in order to accelerate what we do so we can get to that revenue models that we want to. There's two things that we want to grow on our side. We want to grow on product offering. So we've developed a data management platform that offers all the aspects of cloud presence, security, collaboration, and then on top of it started adding vertical products which speak the language of finance. So the equity and fixed income, settlements, loans, data infrastructure, payments and derivatives, all that activity is there. But there's the product isn't an asset-specific product. It's a platform. So now we want to add more products. But each time we add a product, we're building a community. So you need to run a community. You need to operate it. You need a figurehead to be the representative of that community. So every time we launch a brand new vertical, it's a community that we're launching. So kind of borrowing terminology from other businesses of the community, but we're creating an ecosystem. So you need the person to run that ecosystem. So that expansion requires upfront investment until the momentum is there with the community building behind it. So you do early funding for that. The second thing we're doing is an expansion of the geographical presence. We came out to the market with a very strong freemium to premium model. The freemium allows to collaborate on data, and the premium is actually the extraction of the value of all that data. And we have hundreds of participants who have an appetite and an eagerness to move to the premium, because the premium is not a tax. The premium is actually a release of value. When you go to the model where you can actually see there is value in here and I want to extract it, you're converting those into actual clients. There's so many more clients that we're able to handle right now, from a relationship, from a sales, from a maintenance, from an engagement success. We want to be able to tap onto that. So it's growth in coverage and growth in products.
Are there any lessons that you learn from this, from previous fundings or the current one?
It's been such a wild ride. Last round we thought, all right, we're never going to raise money in pandemic again. Do I need to draw any conclusions from that? And the time before that, we never thought we were going to see a financial collapse of two major financial institutions like Lehman and Bear. What do we need to learn from that? But I would say now we're doing it through another eventful period. I think it's more about managing crisis as a dynamic rather than this specific crisis. I don't know that they are, but they seem to be more frequent and more volatile and different every time. It's like try and predict the next one.
Of course, yeah.
There's a few age-old, what is it called? Grandma? It's not grandma's tales. It's like the things you learn, So there's these kind of grandma wisdoms that you have to do, and they're not really new. It's like raise money when you can, not when you need. Raise money when it's abundant. That's always there. But also manage cash. The assumption, and it was confusing for a lot of people that found cash very abundant in the last, again, year to year and a half, and valuations were inflated. You feel like cash is an endless resource. I grew up with a previous company, an environment that would, again, going through volatile times, and cash suddenly contracts and then releases and contracts. So cash management is super important. Doesn't matter how much you think the market is now falling in line and sales are just going to flood through the door, or you're just going to raise more. It's an inevitable cycle. Cash management is critical. Know where you are. Plan for a rainy day. Don't assume for the perfect situation where I'm going to raise money exactly when I need to get the maximum valuation. People get infatuated with valuations and optimizing, but it's really the end run that matters. So cash management is very important. And I think that finding the right investors, and there's not necessarily a key for that. You need a bit of luck and a bit of experience, but finding investors who are actually built to go through the cycles with you is also super important. So we happen to raise, again, in 2 crisis modes, but the people that, the firms that step in, both WestCap and Dawn Capital, and again, I'm going to name the banks that stood next to us through the whole time, understood the long-term vision, saw opportunity where people saw concern, but also weren't blinded by the other side of the equation where people were kind of in the bull rush market that we had. So finding the right investors on this journey together means that these are opportunities to grow, opportunity to realign, readjust, definitely not to slow down, and definitely not to start thinking short term. It's a long-term play when you come into a company in our stage. So I don't have a magic button you can press and say, is this upcoming investor the right strategic one? But understanding their portfolio, how long they've been around,
Of course, yeah.
pays a big dividend when the market goes a bit crazy.
Right. And in the past, has the funding ever come in too late or maybe not soon enough?
The younger you are in the stages of the company, the less runway you have, the more you get into these crunch points where the cash management we spoke about 2 seconds ago is a lot harder to manage because you just don't have that much of it. When we were in the Series A, pre-Series A, we were literally at the point where we really believed in the company. We were struggling to raise money because we hadn't achieved much. It was early days. And we basically decided to self-fund for a while. And self-fund mean that we took no salaries. We took reduced, like, what do you need to keep the lights on at home? We didn't want to slow down because we were building so much technology, but we couldn't afford to run forever. And it got to the point where you start eating into your own savings. Series A was definitely pushing us all the way down to the wire. I can talk about it now, but it wasn't far from having a conversation about moving back to living with parents because the cash flow wasn't there. But I have to say, the hardest thing with cash management is, especially when you start a company, you bring people that you trust, you bring friends, you worry about their financial stability, what the impact is. You take it with such a personal conversation. Not that it changes later, you even have more employees. But again, the runway you're managing when you're a bigger company is very different to the runway you're managing when you're a smaller company. So our Series A was way past the point of, okay, we need cash right now, way past. And it was a personal sacrifice we were making because we believed in it. With Series B, well, our round didn't materialize because of the Corona incident. We were managing cash. So even though it was done, the deal was literally done, we were managing cash smartly enough and preparing for a rainy day, so we were okay lasting a few months and then closing the round we wanted to. This time it's a completely different thing. Now it's a question of growth. The company's generating revenues. We have cash, but we want to accelerate. And in the context of cash management, I will not accelerate risking the runway we have. I will accelerate only if we know there's the ability to then have a horizon of continuing that acceleration. So yeah, that was the trigger for this round.
Right. And can you describe how you felt when you knew that the funding was secured?
It's a funny one. This round, it was different. Forget about everything happening in the dynamics of the transaction and the conversations. This round was kind of closed and done about 3 months before we actually finished it officially. So we were done with the terms. We renegotiated and realigned everything we needed to on the back of the transformation in the market. And then it took us about 3 months of literally, I was telling all my colleagues, we're done in a week. And it took a long time on the legal aspect of it. And again, yes, the legal aspect was an impact of the financial times and everything that was happening, and extra protection and it was also the transformation from a primarily a strategic investor group to strategic plus VCs and the impact of that one. I think for all of us, everyone put in a massive effort on both the existing investors, new and us. But by the time we finished it, because it took so long from when we thought we were done, it was like there was such an anticlimax, it was funny. So it's only when I announced it to our staff and our employees about a week or 2 weeks later that I felt that moment, because people who weren't involved in the day-to-day, it was fun and everyone was excited. That's when I felt it. The actual day itself, it was like, finally we're done. All right, let's move on. We're back to work. It was a weird round.
And finally, after all the hard work, what are you going to do to celebrate this announcement?
Nothing. The opportunity we have is so dramatic. Like, everything that is a distraction for me takes away from everyone's hunger. I mean, investors come in and say, we want you hungry, and I believe in that. I want everyone in our stuff to be hungry. No one should take their eye off the ball and figure out we have only to lose and nothing to gain, because I see an opportunity that's ours to win. The minute we start losing a bit of an edge or getting a bit of... we're not at that stage yet. Let's say it's a 5-minute celebration. We have created an opportunity. It's not ours yet. We haven't monetized it yet. I'm not celebrating anything. This funding is something that we have to do. So there's same way that we close a deal, it's nice, we've done it, but now I have to close 5 more deals. This funding is just something that has to happen. For me, it's not a champagne bottle opening moment. And we'll do that when we create a company that's sustainable, employees are able to get cash out, then we all celebrate. Until then, pinball machine to do what? We close the round? Doesn't excite me.
Thank you to Roy for giving me the time to speak to him. He will be appearing later on in the series alongside some other guests, discussing slightly different topics around trading technology, so stay tuned for that. Please head to our LinkedIn page or our website for any more information regarding AccessFintech. But for now, thanks for listening to The Network Effect. Catch you next time.